Welcome to Midstate Money Talk. My name is Cynthia DeFazio, joined today by Kevin Dietrich and Joe Dietrich, partners of First Choice Financial Services Incorporated. And to our viewers at home, as you know, we are unveiling a 4-part series. Well, last week we talked a little bit about RMDs. This week we're going to jump into taxes, but in case you're tuning in for the very first time, I want to tell you what's to come. Obviously, we talked about RMDs last week. This week is all about taxes, but also we're going to talk about retirement and income planning coming up, and also life insurance, healthcare, and estate planning. It's a 4-part series, and if you miss any of it, you can jump on YouTube and catch up. But let's talk a little bit about today's show. You've worked your entire life to get to the retirement years, and maybe you're planning on reducing your golf handicap. You're going to have all kinds of spare time, and you're thinking about how you're going to fill that time. But are you thinking about the hidden tax implications and burdens that you might be carrying? Is that something that you're thinking about when you're planning your taxes? We're going to unveil some 12 tax hacks in today's show. Grab a pen, grab some paper, and write them down. These are going to be some great ones. Joe, how are you this morning?
I'm doing well. Thanks for asking.
So good to see you
Thank
again.
you.
And Kevin, how are you?
I'm fantastic. Thank you.
So glad to be with both of you. And again, I know how busy you are. Obviously, the show is doing so well in Pennsylvania. People are calling in. They want to book time with you. They always have questions all about retirement planning because you're sharing information online and in the studio, if you will, people haven't heard before. It's brand new. And they're like, oh, I need to get that. I need to get a plan. Especially today's show. Wow, taxes. Nobody likes to talk about taxes. No one that I know. You guys like to, because we're going to uncover 12 things that are tax hacks, but people just don't like to talk about it.
Right.
It can be a little scary. So you came up with 12 2025 tax hacks to help those viewers at home. Kevin, how was that born?
That's born out of necessity. We have a 5-step process that we use, and tax planning is right there towards the top of it. And it's just the unknown that people have concerns about.
Sure.
As I mentioned last episode, and I think you mentioned as well, is that we don't know what the tax bracket is going to be like in the future.
No.
So we have to plan now, and so now is the time to start that planning. But also, it can be one of the biggest expenses in retirement, so we need to make sure that we have a plan set for that.
Sure, absolutely.
Was there ever a time when taxes weren't, a major concern, right? Regardless of where we're at. But, we talk a lot about our retirement accounts. A lot of our retirement accounts are qualified accounts, which means we have not yet paid taxes on. And even if we've done a really great job and our savings rate has been right on track and we are ready, we look at that big number, hopefully a big number, and we don't always recognize that not all of that is ours. We've got another person on that account that's going to be owed some of that money. So if you're in a 24% tax bracket, think about that. Well, your account, almost a quarter of it isn't going to be yours.
Wow.
It's a little bit scary, right?
Yes.
So,
yes.
this is a pretty important topic.
So there's a partner in your retirement plan, right? Yeah, Uncle Sam
Sometimes
with you.
an unwanted partner. Yeah.
Uncle Sam.
Oh my goodness. Well, we talked about RMDs obviously last week to our viewers at home. Let's talk a little bit about tax hack number 1, which is optimize required minimum distributions. Yeah. Who wants to start on that one?
Yeah, it's a bit of a recap from the episode last week. If you have not caught it, like you said, you could catch it on YouTube.
Yes.
But required minimum distributions at either age 70 or 75, you are going to be required to take a specified number of dollars out of your qualified accounts. Depending on whether yours is going to be 73 or 75, it's going to be divided by a factoring number, which will give you a specific dollar number in which you've got to take out.
Okay.
And so tax hack number 1 is have a plan for your RMDs. Are these going to be part of your income plan? Are they going to be something that you give to a charity under a qualified charitable distribution? Or is it going to be something that we should be planning for now to try to reduce that qualified number and therefore the qualified RMDs through things like maybe Roth conversions?
Okay. Yeah. All right. Perfect.
Yeah.
Kevin, this next one I'm going to guide to you. Tax hack number 2, if you're writing this down at home, tax efficient withdrawal strategies. Why are those important?
Yeah, because it's important to know where to draw the money from. If you have a lot of folks come into our office that have a couple IRAs, couple old 401ks that they never rolled over into the new 401k. So when you leave an employer, your 401k really just turns into like an IRA because there's no longer any contributions going into that 401k.
Okay.
So you might have 4 or 5, 6 IRAs, qualified accounts, Where do I draw that money from? Can I draw it from each one? Yes, you can. Can I withdraw from one of those to satisfy the RMDs for all of them? Yes, you can. So tax withdrawal strategy is, and you might not know how to do that or where to pull the money from. So that's why it's helpful to just get with someone that does retirement planning like us.
Yes.
And we can sit down and review all of your accounts and make sure that, see which one's the best option to pull from for different purposes and different reasons, and we'll get into that at that time. But
Sure.
Yeah, there's different, the sources of income, you need to know what they are, and they're going to be unique to the individual. The qualified accounts, but either taxable accounts or non-qualified accounts, we're going to have a different tax structure, or cash sitting around, or Roth accounts. Your specific needs throughout retirement are going to be unique to you. So how you may layer those withdrawals, they might not all come from a qualified account. The ones that do come from qualified accounts, which one is the best that you want to choose from, but you want to be able to layer that income to be able to maximize your tax brackets. We have tax brackets width and depth, right?
Yes.
You got your 10, 12, 22, all that kind of stuff, but you also have the income brackets that also change. So if you make $50,000 to $100,000, or the numbers change every year. So even though you think, well, I'm in the 22% tax bracket or 12% tax bracket, you might be surprised from year to year how that changes.
Sure.
Absolutely. And I definitely want to get into this next one, number 3. But before we do that, I'm so excited to talk about taxfirst.net. This is kind of new to the company. We unveiled this actually last week in our first episode. But why is this so important, and what's so exciting about it? What can people find out when they visit taxfirst.net?
Well, it's a tax calculator that we've developed, and you can put your information there that they require for you to do, and then it spits out a bunch of information. And it's going to be a little confusing. I'm just going to be honest with you. So it's important to get a hold of us for us to walk you through that tool. And but you might understand a couple different things. It shows you what your tax burden may be toward at a certain particular age, what the RMD amount may be. I keep saying may because those numbers change, right?
Absolutely.
And if you can do some Roth conversions, if you do all of your qualified money in one shot, a Roth conversion, what does that look like? If we do incrementally, what does that look like? And so there's a lot of information that goes into the calculator, and it could be overwhelming when you get the information back. So pick up the phone, call us, we'll walk you through that very easily.
I love that. And I definitely want to talk about that just
it's a really good first step. It's not the end-all, be-all of your answer. It's the first step to understand that, is it going to be beneficial for me to look at what my RMDs are going to be? Am I prepared for them? And do I need to start planning how to reduce them? Is a Roth conversion going to be helpful for me? So it's a good first step, but like Kevin said, it's important that once you've gone through that, have somebody sit down with you and walk through that and what that really means and how it fits into your plan.
Yep.
Absolutely, Joe. Thank you so much. Kevin, there's a very special message, or known as an offer, if you will, that you want to present to the viewers at home before we take our first commercial break. Can you spend some time talking about that?
Yeah, it's very similar. We just talked about with the tax calculator. Give us a call. We're going to set up a complimentary strategy session for you, and we're going to put a plan together uniquely to you, which will touch all of our topics we're going to talk about over the next several weeks.
Yes.
We're going to do a financial review with you. We're going to make sure you have an income plan in place, tax plan in place, make sure you have a plan for the health care, and then, of course, leaving the money to your beneficiaries in the legacy planning. So that's a strategy session and a plan that we put together for customized to you as the individual.
Kevin, thank you so much. Joe, thank you so much. To our viewers at home, the number to call is 888-959-2743. If you're in the viewing audience today and you're hearing some of this information for the very first time and you realize that you need a plan for your retirement, I can't think of a better time than right now to call in, 888-959-2743, or better still, you can grab your smartphone, click on the QR code at the bottom corner of your screen. That'll take you to taxfirst.net, where you can put in some information about yourself, and you can see what your tax implications could be. It might be very surprising to you. We're going to take a very short commercial break. Don't go anywhere. When we come back, we're going to talk about, are your Social Security benefits, are they taxable? Find out. Stay tuned.
When we tell someone something, they'll say, we can take that to the bank. If we can't do something, we'll tell them that. We're straight up with our clients. It all comes down to using the products for the people's needs, not selling product.
Being independent means that we have freedom to do what's best for our clients. We're not beholden to any other party to make sure that we're meeting a quota or restricted on what it is that we can do or provide. We're free to go out into the market and find what's best for them and what's going to meet their needs.
The world's our oyster, as far as what resources we have for our clients, and that's beneficial for our clients more than anything.
Don't be afraid to go ask for help. Find somebody you can trust and start the process. Obviously, the financial part is very important. Having a plan in place that's going to provide you with sustainable income, that's resilient to the changes of life and of the market, that's really important.
Money doesn't care who it serves. And one of the things that we like to do in our company is we like to be able to help people determine where their money is going to be and who it's going to serve generation after generation.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Kevin Dietrich and Joe Dietrich, partners of First Choice Financial Services. And today we're talking all about those hidden taxes that can sneak up on you during retirement and some hacks that will help you avoid those so that you can have peace of mind. The next one is so important to jump into because I know people are curious about this. Managing your Social Security taxes. What? Wait, it's taxable? I don't want to talk about being taxable. Who wants to talk a little bit about that?
Yeah, Social Security, your Social Security can be subject to tax.
Oh,
and that's very important that we use that can be. It depends on your other income. So if you have a pension, if you have maybe you're working part-time, so it depends on the other income. And there's a formula, a bracket. I think if you're married if you file a married filing jointly, it's like $34,000. Don't hold me to that figure, but it's something around that number.
Okay.
If your adjusted gross is over that, up to 85% of your Social Security is subject to tax.
Wow.
Now, your Social Security income does go into that factor, into that formula, half of that. So half of your Social Security income, all of your other ordinary income, dividends, capital gains, all that goes into that formula. And that formula is called provisional income. And that's how it's determined how much of your Social Security is subject to tax at that time.
Wow.
So it can be up to 85% of your Social Security can be subject to tax.
Yikes.
So that's huge.
That's huge.
It's just important to know that and have a plan in place. Some of our clients can't avoid it. If you have a pension and you have a good Social Security check coming in, you're going to pay tax on your Social Security. That's just the bottom line. And so how do we manage that?
Yeah.
And what do we do about that going forward? So that's important.
You have to have a plan. That's really what it comes down to. You need a plan.
It'd be surprising how many people we meet that they never thought about it and they don't think that Social Security is subject to tax. And obviously maybe a little upset that it is, but like Kevin said, and you might be in a situation where you're unavoidable. 85% of it is going to be subject to tax or up to. But then you might be in a situation where you have some control that may be only 50% or a portion of it. And so it's always nice to know and be able to maximize that if you can.
Absolutely. It makes perfect sense.
Yeah.
Joe, this next one, tax hack number 4, take advantage of Roth IRA conversions. Can you talk about that, number 4?
Yep, absolutely. If you haven't already opened up a Roth account, you should consider it. You should talk to somebody like us, whether that's going to be beneficial for you, because this could be a very powerful tax tool. Particularly if after you've done working, you maybe have an area where you've delayed your Social Security or you've got a lower income bracket, and then later down the road, we've talked about those RMDs, that's going to go back up. Well, now we're in a window where we could tax efficiently convert some IRA money to Roth money. Well, why is that important? Well, now all of a sudden we are paying at the lowest tax bracket possible for your situation, and moving money out of an IRA, which you may later be paying a higher tax bracket on and be forced to take anyways. And so this does a couple of things. It also then gives us a pool of money, which is now growing tax-free. Tax-free is kind of good, right? Everybody likes tax-free.
Yes.
So now we got a pool of money, and that goes back to something else we talked about, is having an efficient withdrawal schedule. So now all of a sudden we've got taxable, tax-free money. We've got multiple buckets to start drawing from. That gives us another tool in our belt.
Okay, perfect, Joe. Thank you so much. Kevin, what about this next one, leverage standard deductions and itemized weeklies? leverage standard deductions or itemize wisely with glasses.
Itemize
You're
wisely.
like, weekly, what is she talking about?
So we have a
Wisely.
standard deduction under the Trump tax law of which is substantial.
Okay.
It's around almost $30,000 is the standard deduction if you're married,
year.
filing jointly.
For this year,
For this year,
$30,000,
yes.
yeah.
Okay.
2025. And so sometimes, before we would always itemize our expenses and our deductions, but we can still do that. We maybe make sure that we do that on a regular basis and always revisit that.
Yep.
But if it's under that standard deduction amount, obviously we want to take that standard deduction amount. But it's important for us to still leverage that and still not just forget about that because of the standard deduction is so high. So we still need to look at that and review that. And we need to bunch our deductions. And charitable donations is one of those, medical bills. So we need to make sure we're maximizing those deductions that we are eligible for in our taxes.
Would that be medical bills as well? Would you
Yes.
Medical
pool
bills
those
in there,
in?
charitable donations.
If they reach a certain percentage of your income, your long-term care premiums, those kind of things. So like you said, most people, standard deduction in the current environment is going to be the way to go, but you should be checking. You need to make sure, do an overview of what those deductions might be for you. And if you're in a situation where you're giving to charity, you might be able to bunch those contributions, maybe hold them for a few months or for a year, and then do them all in 1 year. And then now you're in a situation where itemization will be the best option for you. So there's a couple of strategies you might want to look at for that.
Yeah, I mean, tax hack number 5, really we can talk about, be proactive
Yes.
in our taxes. And so don't just take what the tax preparer says that you owe. Make sure that you're prioritizing and that you're proactive and you're involved in that process.
Sure.
It's that money that you're paying, it's coming out of your pocket, and you don't want to pay more tax than necessary.
No one does that. No, absolutely. This next one, Joe, understand the tax on your income sources, tax credits, and deductions. Can we talk about that for a little bit?
Yeah, absolutely. So each source of income is going to have its own tax obligation, and whether it's going to be IRA or your brokerage account, which has capital gains or interest income. Your Roth accounts are going to be tax-free if they're structured properly and the timing's properly. There's some rules around that. But there's also like state tax. We understand federal and state tax. Pennsylvania, we're lucky. Retirement income is not taxed on a state level. So, but perhaps you're thinking about relocating at some point in retirement. You probably should know before you go where you're going and whether that could increase your tax burden. So understanding the sources of all of those, what credits and deductions you're available, kind of goes with tax hack number 5.
It does.
Yeah. Combination of there. I guess bottom line, 5 and 6 is take a little time to educate yourself. Sit down with somebody who knows what they're doing, can put together a plan for you, and give you a clear roadmap of what you can expect.
That's what everyone needs, is that roadmap.
That's right.
Kevin, let me ask you this next one before we take a commercial break. Number 7, capitalize on tax-efficient investments. Why is that important?
Yeah, shifting some of your portfolios to tax-efficient investments can reduce the taxes owed on investment income once you retire.
Okay.
Municipal bonds, for instance, provides tax-free interest. Roth conversions provide that tax-free, growth. So we just need to make sure that we're being proactive again in our tax strategies and making sure that we're putting money into tax, efficient investments.
Yeah, when we're talking about the investment strategy, a lot of times we don't realize that each type of account and their tax qualifications should impact which investments you put into those accounts. And so, for instance, your IRA, if you've got bonds and interest and dividends, all that stuff's going and rolling, no problem. But if it's in a taxable account and you're now having taxable obligations every year, well, you may want to make some adjustments.
Okay, all right.
Yeah.
And I know that that's something that you're so passionate about, obviously, at First Choice Financial Services. And Joe, there's a very special message offer that you have to the viewers
Yes,
at home.
absolutely.
Talk about what that is before we take a commercial break.
Yeah, so we're talking about tax hacks today, and taxes are just one part of your overall financial health, your overall financial retirement plan. So, we're retirement specialists. This is what we do. We sit down and we create a holistic plan for everybody, the individual to them. Your situation is going to be unique to you. So I encourage you to pick up the phone, call the number on the screen, set an appointment with us to go over that. There's also a QR code. Grab your cell phone, snap a picture of that, and scan that QR code. It'll do the same thing. You'll be able to set a time to come in and talk to us. We would love to meet with you and see where we can help you.
Joe, thank you so much.
Absolutely.
Kevin, thank you so
you.
much. To our viewers at home, that number to call is 888-959-2743. And as you know, today's show is dedicated to tax hacks that you can take advantage of in your retirement years. I do want to mention that website again one more time. That is taxfirst.net. taxfirst.net with the number 1, just like First Choice Financial Services Incorporated. If you're wondering what your tax implication and burden is currently today without making a plan, please visit that website, taxfirst.net. We're going to take a very short commercial break. When we come back, I want to talk to Joe and Kevin about what about planning your health care? Would there be taxes on that? Stay tuned.
Did you know your retirement savings isn't entirely yours? That's right. Your traditional 401k, IRA, or pension is actually shared with the IRS. And when it's time to take a withdrawal, they'll be waiting there for their cut of your tax dollars. Want to know how much you owe? Try our easy-to-use tax bill calculator to find out. Just scan the QR code or visit taxfirst.net.
Welcome back to Mid-State Money Talk. My name is Cynthia DeFazio, joined today by Kevin Dietrich and Joe Dietrich, partners of First Choice Financial Services Incorporated. To our viewers at home, we're talking about some 2025 tax hacks to help you as you navigate that road to retirement. Joe, this next one, let me guide this to you. Plan for health care expenses. Why is that important? Is that a hack?
Absolutely. Absolutely. Healthcare can be a major expense in retirement. Newsflash, right? Prices are going to go up, and healthcare medical inflation has gone up faster than regular inflation over the years, and so we need to plan for that. If you obviously we want to forecast what kind of maybe Medicare and Medigap and all of those great coverages, what's right for you, but we also want to plan ahead of time. You may want to take advantage of an HSA, a health savings account. So now, while you can't have that while you're on Medicare, the years prior you could be saving up and then using those monies in retirement. This is a big tax hack. So we're contributing to our HSA on pre-tax dollars that has not been subject to tax yet. And when we spend them on qualified medical expenses, we get a tax break there. They're not taxed when they come out.
Okay.
So, so you might want to ask yourself, as you're working, cash flow is good, we're saving within our HSA, and we have a couple of medical bills coming up, we're still rather healthy, that's okay. Do we want to use that money now? Do we want to save that and defer that later? And so maybe our health's not so good, we might get that tax benefit there.
Okay. All right, Joe, thank you.
Okay.
Kevin, number 9, be strategic when selling assets. That's a big one. Be strategic when selling assets.
Yep.
Yeah, it goes back to being proactive, making sure that you're working with someone that can give you some guidance. You know, when you're involved in something, you're totally involved with it, and you don't really look around and see what's going on. And
it's true.
And we're also emotional creatures, in case you didn't know that.
That is true.
So selling investments, real estate, other appreciated values in retirement can trigger some capital gains. So we need to make sure that we're doing these strategically and in the right timing of it. It sort of goes along with Roth conversions as well. Like when you pull the money out of the IRA, put into the Roth, you pay tax on that. And maybe that's not the best time to do that in a particular year that you're still working and making some 6-figure income. So it's just these being proactive and being strategic in our planning.
Okay.
Yep.
Okay, it's all about proper planning. That's really what it comes down to. Let me guide this next one to you, Joe, really quickly. Watch for the Medicare surtax, otherwise known as IRMA, tax hack number 10, if you will.
Yeah, so the surtax and IRMA can be tricky.
Okay.
If our income levels hit a certain bracket, now our Part B and our Part D premiums can go up significantly. They can go, in fact, they're tiered. So each time you hit to another tier, the increase goes up. So an IRMA increase could double your Part B premium, and your D could be impacted as well. So understand what that is going to be. You know, we recently met with a couple who had no idea that this could happen, and all of a sudden we're looking back and saying, it's too late, I'm going to, and they were pretty upset about it.
Sure.
So wouldn't you like to know that ahead of time? And in fact, know it ahead of time and you might have been able to avoid it.
Absolutely.
So this is tax hack number 10.
Number 10.
Right.
That brings me to 11. Kevin, for you, use tax loss harvesting to offset gains.
Yeah, very similar to the number 7, capitalize on tax-efficient income investments, and also number 9, because it's just being proactive. Again, we keep saying that, but it's not.
Yes.
We're not just trying to put this question off. It's being proactive and making sure that we're taking advantage of that tax loss harvesting. And Joe actually could talk about a little bit better than I can with the tax loss harvesting.
Okay.
Yeah, so you may have accounts that some of the accounts going up, some of the accounts going down. At any given time, some investments are doing well and some are losing. And so particularly if you're in a situation where you have concentrated positions, like a large amount of your portfolio in one area, or you're in an area where you need to be reducing your risk because of the risk tolerance that you have or the age that you're getting into, preparing for distributions, a whole slew of things. But you need to start rebalancing that portfolio. Well, now we need to start transitioning that to different investments. We want to be able to take some tax loss harvesting on the investments that maybe weren't doing so good, and that'll help kind of counteract some of the capital gains that we are going to experience by doing all of that. So you need. It's really helpful to be with a professional that can look at this and make some forecasts and put a plan on how you're going to transition those things.
Yep.
It's so important, and it ties into our final one, number 12. Don't forget estate and gift taxes. That's a big one. They go hand in hand.
Yeah. The federal estate tax applies to estates exceeding $12.92 million. So not a whole lot of people are in that boat.
Right.
But we should need to be aware of that. And the gift tax for this year, 2025, annual gift tax is $19,000 per recipient.
Wow.
So if you have money that you want to leave to your grandkids, your kids, or your nieces and nephews, you can give them $19,000 per year per recipient for this year, 2025, and that's a huge thing.
Absolutely, it is.
Yep. So those are just things that we need to be aware of and make sure that we're able to take advantage of.
Yeah. Start
Perfect.
transitioning some of that estate.
Yeah.
Gentlemen, thank you for another amazing episode this week. I truly appreciate it. I know the viewers do as well. To our viewers at home, that number to call in, 888-959-2743. You need a plan not only for your retirement years, but specifically a tax plan. If you're curious about what your implication could be, go to taxfirst.net. Put a little information in, and you will be surprised at what you see. Be safe, be happy, and be blessed. We'll see you back next week for retirement and income planning in our 4-part series. Take care.